And it appears we are live with another edition of Lumberjack Logic. That's right, a live show, folks. Welcome to another edition of Lumberjack Logic Live. There it is. I knew I had that up somewhere. Now I can't find it. And bam, there it is. All right, got it. All right, super duper. All right, folks, I've got a special guest tonight. It's going to be awesome. Seriously, I really like this guy, and you're going to like him too. You're going to like him for a number of reasons. I met this gentleman through his involvement in the election integrity movement. He's done a lot of work for it. He's worked closely with Garland Favorito, and but not only that, he is also an asset manager. He's a financial advisor, and really, I've talked with him numerous times just about the markets and what's going on in the world. And right now, we've got, banks going down. Silicon Valley Bank. That's the second largest bank collapse in U.S. history, is my understanding. I've got an article I'm going to refer back to on that a little bit. But also a bank that engaged in full wokeism and is now being bailed out. Yeah, bailed out. And I'm going to probably ask David a few questions about that as well. But it's disturbing times. People are wondering, what do you do? I got to be honest. I wonder what to do. Silver was way up today. I think it went up by like 6-7%. Had a huge move in silver. I have bought silver. I'm a believer in that, but I don't put all my eggs in one basket either. And you know what? At the end of the day, I need cash to buy things. So I got to keep some cash on hand. There's just a lot of different things with financial management, and that's why I'm so excited to have our guest on. Before we begin the show, I do want to mention my sponsor. That's right, My Pillow. There he is, Mr. Mike Lindell with My Coffee. I'm telling you, folks, I just made a little pour over my coffee. Oh, it's Nirvana. Oh, I love this stuff. I do, man. This is the greatest coffee. And it's so funny because I didn't think he was going to make great coffee, but you got the coffee to wake you up after you rest on your new My Pillow 2.0, folks. That's right. I got the My Pillow 2.0. I've been using it. It does have that cooling technology fabric. You'll love it. But without further ado, I want to get into the show, man, because I'm excited about this show. So go to mypillow.com, promo code Lumberjack for big savings, huge savings so big you can't even stand it, people. Savings up to 66%. Actually, right now, the slippers are an even bigger buy, so check that out. But without further ado, I want to welcome my guest in. I have David Cross from the great state of Georgia, where kind of I guess it's a swing state. I'm not going to get into all that, David. We're going to talk money tonight, okay? We're going to talk money. So that's what we're here to talk about. People, I think, are very nervous. They're seeing... I think for many people who lived through the 2008 financial crisis, they're seeing flashbacks. I think you feel this one's drastically different, and we're going to get into your reasons why. I do want to bring something up and get your thoughts on this, not necessarily with the financial, but on the political side of finance. DC Drano tweeted out, "Where's the bailout for East Palestine houses that have plunged in value? The farmland that's poisoned, the restaurants and businesses that people won't visit anymore. They're all left to die. But if you're woke big tech, you get every dollar you need in a single weekend." And I love that tweet from DC Drano, which, by the way, if you're on Twitter, that's a must follow. DC Drano. The guy's great. He's an attorney, I do believe, correct?
Yes, I believe so.
Yeah. So you're on Twitter as well. They can follow you there at GA Ballots.
Correct.
GA Ballots on Twitter. And David, that's not where he gives you financial advice. That's where he gives you political malfeasance advice. So anyways, but guys, give a big hand clap to David, because David has done a lot of work pro bono for this movement, and I'm very grateful for the work he's done, because he's done so much. And some of you will recognize David for being on the show before. So that being said, David, let's talk a little bit about this Silicon Valley Bank. There's another bank that went down too. I'm trying to remember which one that is. Maybe you've got that information on top of your...
Signature Bank in New York.
Yes, Signature Bank in New York. That's a Fed takeover of that one too.
Yeah, what's really ironic about that one is that Barney Frank, who was one of the chief instigators that actually he was one of the major causes of the 2008 meltdown.
Yes.
He was on the board of directors for Signature Bank, and I hope he owned a lot of stock.
Yeah. He probably sold it all like the people from SVP.
Well, he probably counted his net worth, but that thing went to zero today.
Zero. Still, what's Silicon Valley Bank? Because I saw they are at zero because I saw it was down because I suppose once they do the takeover, then it comes down to zero, right?
Yeah. So Silicon Valley's stock was around 700 or so, a little over a year ago, and it was around 200. I think it was up like around 250, maybe like 3 or 4 months ago, and it just kept it was dropping and dropping. And so I think on Friday, on Friday it didn't even open. It closed on Thursday like around 100, and on Friday morning it was supposed to open, and it was halted. And I think there was maybe like some pre-market trading like around 35 or so, and then they just stopped it. And
they halted trading today
on a bunch of banks and financial companies.
Yeah.
There were quite a few that were down around 20%. And once a stock is down about 20% in heavy volume, it's around 20% based upon some other factors, but they'll halt trading. And that just kind of like gives the world like a moment to just kind of digest the information that's coming out there. So not everything that was down, should have been down, but it's kind of like guilt by association at this point, where a lot of people just say, oh my goodness, if that one's bad, then they all got to be bad.
Yeah. Well, I mean, since they've all gone woke, they maybe should go broke. But anyhow, that's all. Look, people, I got to tell you something. David actually reached out to me a little while ago about sponsoring the show because we're kind of like mind, and so we're gonna do that. So I do want to mention something here. He's got a website, and he's a fee-only financial planner. So it's us-am.com to get to David's website. He is a fee-based financial planner. That's his trade, and he's done well for his clients, in down markets, not losing as much or even staying above water. So it's somebody with you. So you're dealing with somebody. The great thing about David is you're dealing with somebody with a conservative mindset, conservative values, which is important. My daughter came up to me today, actually, and she asked me about our bank because we bank at a community bank. We know the owner. We go hunting with him and everything. And I said, well, the great thing about our bank, Rebecca, is that we know the owner and we actually know how he thinks. And he's a little more conservative than Silicon Valley Bank. He actually treats loan loss reserves as a real thing. So that's I think when you're working with David, if you decide to do that, us-am.com to get to his website. And I guess, David, just for sake of introducing yourself to the people, just tell them a little bit about your history in financial planning and your philosophy, I guess, and then what you see going on in the markets today.
Okay, so before we get into that, we are a very highly regulated business, and so I got to get a couple, little housekeeping items done. So yes. The first one is that so my company, US Asset Management, we are a member of another group called Advisory Services Network LLC, and so Advisory Services Network provides like all my back office, and compliance issues and that kind of thing. And there's a bunch of other advisory companies and practices that are out there in the country that use Advisory Services Network, and I happen to be one of the companies that works with them. And then with regard to anything we're going to be talking about tonight, you need to understand that none of what I'm going to talk about tonight is specific financial advice because, I don't know you. I'm just now getting to know Neil and his situation. But anything that we talk about tonight is really for informational purposes only. And if you have specific questions, you can certainly reach out to me. And I think we're going to have a landing page on us-am.com where you can, take a look at sending us some information. If you have some specific questions and what you want to try to accomplish, you can fill out that form and we'll get back to you right away. And you can also, I think we've also got like a calendar invite on there too, so you can easily, reach out to me, hit me up with your questions. I've been doing this for, kind of getting into what I'm doing. I've been doing this for 32 years. I've been a financial advisor. I'm 53 years old. I studied finance in college, went to Auburn University, They have a fantastic finance program there. And it was, it's been, eye opening. And when I was joking around with a young guy that works for me, he's 24 years old. And I told him today, I said, I think I've lived through at least 3 once in a lifetime financial crashes.
Exactly. We're accelerating financial crashes today. We're doubling the rate of knowledge every 6 months, but we're accelerating financial crashes on top of it.
And so I've been doing this for quite a while, and I'm a student of the markets. That's not to say that I know everything. I don't think anybody does. And particularly like what's going on right now is confusing to a lot of folks and a lot of professionals also. But like I said, I'm a student of the markets. I'm constantly trying to learn. And just as a side note, I'll tell you that my wife and I got into an argument like many years ago before my kids were born. And she said, I know you'll never leave me for another woman because the other woman's your damn job. So that's kind of how much I'm into this. So, I mean, if I can't figure things out, I'm the kind of person that'll also tell you, I don't know, and move on from there.
Yeah, well, it's hard to know. And I think one of the things that happens when you see news like we're seeing right now is people panic. And panic is never the right response. I've heard time and time again, and I think there's a lot of truth to it, is the stock market is motivated by fear and greed. And that's certainly true. I mean, you see people get very greedy in stocks or it's almost like a form of gambling for them. And so it's, there's like planning financially, and then there's gambling, and there's diversification and all of that. So with what so we were talking earlier, and you were saying that you didn't see this as like a 2008 type event. Why is that?
A lot of it has to do with the response. I think that regulators and the government learned from what happened in 2008, where they basically stepped away from everything and said, whatever fails is going to fail. And you just had this cascading domino kind of situation where once it started, it was incredibly hard to stop it. And so at least this time, the government stepped in and said, and I think, some people may disagree with me, but I think correctly said that, if you had money that was on deposit with these people, or with this bank, your money, your currency, is safe. They're wiping out the stockholders. They're probably going to wipe out, quite a bit of the bondholders as well too. And they're going to restructure the bank. And I think that HSBC out of Hong Kong set up a specific subsidiary corporation, and I think they bought the assets today for $1.22. They paid £1, one British pound. So, for that. And that's, honestly, that's probably the right thing to do too, because there was a lot of stupidity that I think that was going on with that bank. And I think there was a lot of lack of risk management that was happening. They were taking risks. They weren't hedged, and they should have been, because they saw interest rates going up. And I guess they just watched interest rates go up and said, we'll worry about that tomorrow. And when you have interest rates going up and you own, when you own a bond portfolio that has a long-term maturities to it, those bonds
were they mainly holding like 10 years, or what were they holding?
Longer, sometimes longer. So they're gonna own like mortgage bonds, are gonna own, commercial real estate bonds. It's basically long-term obligations, where I think maybe like their average yield on those instruments was maybe like in the neighborhood of like 3.5% or so.
Okay, so I actually love talking banking, because I've worked in the banking industry a bit, and one of my best friends owns a couple bank groups, and I talk to him about banking all the time. So just so those out in the audience understand here, there's a bond market, and banks buy bonds and they lend against that. Basically, I mean, they lend money out at interest rate A, and they're buying it at interest rate B. And there's an inverse correlation in the bond market with yield and pricing. And maybe we could just talk bonds a little bit here, David.
Sure. I think everybody who's listening is really more familiar with bonds than they know, because if you've gone to a bank and you've ever bought a CD, a certificate of deposit, that's a bond. You're lending money to the bank at whatever interest rate that they're willing to pay. They are obligated to pay that money back to you, in the future. And, if look at it like this, if you went into the bank today and they said, hey, we have and you're not going to see this, but I mean, just for instance, most banks have got like 6-month CDs and 1-year CDs and maybe 2-year CDs. Occasionally you'll find like a 5-year CD. But imagine like walking into a bank and the bank says, hey, we got this awesome deal. CDs are going to pay you, 5%, but you have to lock up your money for 20 years. And if you pull the money out, early, there's going to be a substantial penalty for early withdrawal and all that kind of thing. But 20 years and it's 5%. Now imagine for a second that interest rates go up to 10%. Well, that 5% CD that you bought, it's only paying 5% when anybody else that's going out to buy a CD right now is going to get 10%. Your 5% CD must have fallen in value because it's not worth as much as 10%. So that when we talk about interest rates going up and bond prices going down, that's exactly what's happening. And you need to think about bonds in terms of like it's a CD. It's an obligation that the bank owes you money. But in the bond market, you're lending money to corporations, or you might be, lending money to other banks where they're making loans on commercial property and
or
things
government
like that.
institutions. That's a popular one too.
Yeah, even the United States government has got bonds.
So yeah, and county governments bond and all these, they're bond. Yeah, it's
and believe it or not, the bond market is vastly larger than the stock market.
I know, it's wild. So back when I used to sell sales training, David, I dealt with some bond traders and bond brokers, whatever, and I couldn't believe how big the bond market is. It's colossal. It's ginormous. Yep. And so Silicon Valley Bank, they had a lot of long-term bonds, long-term obligations. As interest rates here recently have gone up dramatically, people, what happens is that the bank is only receiving, let's say
3%,
2% even on some of this stuff. I mean, it's just very, very limited. And then they're trying to, borrow out at a different interest rate, but that's on your shorter term notes that were at that lower rate. So when they took out those longer term, those rates, they don't have any margin, I guess is what I'm trying to say. There's no margin.
Yeah. And the issue too is that, if they lent money to like a commercial real estate developer who's putting up a building, okay, and let's say it's a 20-year, a 20-year bond or a 20-year loan, to the commercial real estate developer, and let's say they're lending that money to him at like 6%. A couple of years ago, 6%, might have been a decent rate. And now after COVID happens, and there aren't as many people that are working, at office buildings, occupancy may have gone down. He's not got enough cash flow that's coming in, and he's not able to stay current, on his payments. And if that happens, then the value that bond can go in default. And so not only can it go in default, but he may get behind on his payments, and then that becomes a big issue for the bank. But even if everything is fantastic, okay, and he is making the payments and everything's great, and he's paying 6%, okay. See if I can get my hands up there. Anyway,
that's inverse. It's inverse. It's like the bond market.
It's weird. It's weird. So he's paying 6%. And it used to be that when you deposited money at the bank, like a year and a half ago, you got like 0-point pocket lent,
mm-hmm.
And now it's up to, 2-3%. So let's say it's 3%. All right. But then, so if the commercial real estate developer is paying the bank 6%, but it's costing them 3% to get to that money, that means that their net profit, their net margin is 3%. But that's before you account for human beings, buildings, and loss reserves. So I mean, things can go south in a hurry, and I think that's been a contributing factor to what's been going on.
Yeah, what is that? Earnings before EBI?
Yeah, EBITDA. Earnings before interest, taxes, depreciation, and amortization.
Yes. So no, it's and banking is it's a tough business. I mean, having a good friend who owns 2 bank groups, I mean, it's it's not as easy as people think it is. Everybody kind of makes everything that they don't do easier than what they do. That's natural human course. And people think bankers are just all rich and they're all just taking you to the cleaners and everything. But it's a competitive. That's why I like capitalism. It's a competitive business. Yeah, and nobody really gets to overcharge for interest rates other than credit card companies. So that's where the mafia money's made, people. It's credit card companies. Don't ever owe money on credit cards.
No, absolutely not. Because I was looking at my American Express card recently, and they said, hey, we made some changes, to the terms on your card, and it said that if you carry a balance, the interest rate is 29.9%. I was like, holy cow, that's like paying the mafia the vig, man. That's crazy.
It is. It's nuts. It's like a pawn shop. It's pawn shop money. So, so your feeling though on this particular crisis is it's not going to be like 2008, just because and to your point, I'm going to throw this out here right now because I got a real conservative audience, and yes, I mean people are going to say, well, they shouldn't bail out the bank. Understood, but should they bail out the depositors?
I honestly think they should bail out depositors, because your average person, that's walking around, they just got paid and they said, hey, I've got my money. I want to go put it someplace safe. I mean, the average person is thinking, the bank, a good bank is going to be a good place to put it. But the problem is the average person has no idea how to evaluate whether or not the bank that they're giving their money to is really sound or not, because they're not going to give you access to the books and to what they own. I mean, that's really the public companies. So smaller banks, no, they're not going to do that. But here's the thing. This is not to say that there's no pain. So anybody who owns stock in Silicon Valley Bank, they got wiped out. I mean, cleaned out down to zero. Anybody who owned bonds got wiped out down to zero. So there was a fair amount of pain, but I don't think it's reasonable for me or you or somebody else that has money on deposit with a bank. We look at our money and it's like, my money is my money, and that should not be. I shouldn't be on the hook for taking risk of like putting my money, at a bank. Institutions, I think, are institutions and big businesses are a different breed. But I think that what's going to happen here is that the damage is probably going to be contained going forward. I think we're probably going to see more banks going under this week and in the coming weeks. But I think and I hope that it is going to be relegated to the stupid. Just the people that have got just the worst managed portfolios, and hopefully that's where it ends, because the last thing we need to have happen is for a bunch of people to go to the bank and say, you need to give me, I want to take all my money and I'm going to go, put it under my mattress or something like that. That doesn't help anybody. It doesn't help capitalism either.
Yeah. I mean, banks are the engine of capitalism. Don't ever kid yourself. I mean, access to capital, access to money. I've taken mission trips to Africa, and one of the things that I witnessed over there was you talk to the business owners, because we talked to some business owners on this missions trip,
right?
And their problem is the banks over there, because the banks want you to have all the money that you want to borrow in the bank before you borrow it. Well, then why wouldn't you just use cash? So it's just that's the lending practices, and it's hard for business to get access to capital, to take risk, and there is risk. I'm telling, don't ever kid yourself. There's always risk in lending money, but you measure your risk. You take smart risk. I mean, over the course of time, I've taken out loans to make business investments that have paid out. I took out a loan one time that did not pay out. It really went bad. So I've seen both ends. I tell you, but I got burned that one time, and I just never got down that road again. Only one ship that doesn't sail, and that's a partnership. Anyway, so I've been real reticent to take out loans. I mean, I certainly am, but I just access to capital, banking is not evil. I just want people to, and Are there evil big banks? Yes, but banking itself as an institution is not.
Well, now hold on a second. There are some evil things that happen with banks. So we've got this system set up in our banking system called fractional banking. And I don't know if you're familiar with this or not, but here's the way it works, right? So
you have a whiteboard? Are we graphing this? Because this.
Oh no, I think people will get this. This is really simple. So you go down. This will be the simplest way. So you go down to the bank and you give them your $5, okay? And you deposit it there. And what happens is the bank says, "That's awesome, Mr. Cross. Thank you for giving us the $5. We're going to put that into like a 5-year CD, and we're going to pay you whatever interest rate." All right. Then the Fed gets involved because the bank turns around and goes to the Fed and says, "Hey, Mr. Fed, we've got, Mr. Cross just deposited his $5 with us, and we've got, we have Neil. He wants to borrow some money from us so we can go buy a piece of real estate." And the Fed says, "That's awesome. And what we're going to do is we're going to give you 10 times what Mr. Cross gave you. So we're going to give you $50, and the bank can then go lend $50 to Neil. And then what's happened here is they've levered $5 into 50. And as long as Neil makes the payments and pays the interest and all that kind of thing, everybody's happy. But if you don't, then the whole thing falls down like a house of cards. And fractional banking is something that I have a real problem with. I think it over leverages the system, and it makes it so that we end up creating and printing too much money over time. And one of my favorite ways to get around that and to not participate in fractional banking is to use like a credit union. Credit unions typically, if you go deposit $50 with them, they're going to hang on to $10 of it, and they might lend out $40 of it. That's how credit unions are just dealing with the money that comes in is the maximum that can be lent out. They're not going out and creating money.
Money creation. I keep thinking of when I was a kid. I saw that Scrooge McDuck. Actually, I wasn't even just a small kid, I was a teenager, but the whole Scrooge McDuck teaching his boys about, because they were gonna have like was it a money tree or I can't even remember, but something that produced dollars, some way to print off money, and Scrooge McDuck was telling them how bad it was, and they go, "What do you mean?" It's bad. And he talked about the woes of inflation because.
Well, look at you. You've got your own money tree. You've got a piece of property, right?
Yeah.
You're cutting timber on it. You're literally cutting down. You're cutting down money, and you're benefiting from it. And how do you get more money later? You let the trees grow. And if you manage the property properly, it can provide for you, and you can collect mailbox money for the rest of your life.
Yeah. Well, it's beautiful. There is money in trees, people. Money does really grow on trees. That's a real thing.
And I love the fact that you can walk through the trees and you can go hunting up there too. So it not only does it work for you and provide money, but it's also good recreation too.
Yes. Also, just another thing my audience will really like about David, and again, I'm going to share his website again here. And full disclosure, David is sponsoring the show, so USAM, us-am.com. But I have sent over for the packets. I'm going to be investing my money with David, so I'm putting my money where my mouth is. Just because, look, he hunts even. He likes guns, stuff like this. I mean, this is just my kind of person. This is my people, and whatnot. So. Let me ask you this question, David. So looking at the landscape, okay, we're saying this probably is going to be like a 2008 type of situation, somewhat limited to the stupid. They're bailing out depositors. Stockholders are, they're getting taken to task. They shouldn't have taken a risk on such a bad bank. But depositors will be able to keep their money. There is a societal cost in that, of course. When a bank goes under like that, for us to then. But I would imagine too, and I don't know how that works, but there had to be still money within the bank and stuff. So when the federal folks come in and take over that bank, those assets are then getting dispersed. So it's not like the assets were zero.
Right.
inside the bank, so that I don't know what the total societal cost of this and the other bank failures that are coming down the way, which we're certainly going to see, because when rates, and you had to know, and I talked to my friend Bruce again, owns banks, and I said, wow, I said, with rates climbing this fast, I said, I understand the bond market and what banks are doing. I said, how bad is this going to get? And he goes, well, he said, I don't think they can do it for forever. I don't think they can continue raising rates forever. And so I think you are going to see rates eventually start coming down. When that occurs, I don't know, but they've been pretty committed to raising rates for a while.
They have been, but something really strange happened today. So on Friday, the 2-year Treasury bond was paying, I think, 5 or 5.1%. Today it dropped to 4.
Wow.
So I've been doing this. Like I said, I've been doing this for 32 years. I've never seen interest rates move like that. So I mean, it seems like it's just some parts of the bond market look like they're just really illiquid right now. I'm not sure why or what's causing that, but either that or there's just oceans of money that's looking for a home. But there are some things. I mean, I'll tell you. I mean, I'll be perfectly honest with you. There are some things out there that don't make a lot of sense to me, and when that happens, I tend to get cautious and defensive. And sometimes the best thing to do is nothing. That can be beneficial sometimes, and it buys you time and buys you flexibility.
Yeah, people undervalue holding cash sometimes. I mean, and like I said, what silver was up. I saw that today. What do you know what that ended up? Silver, it was like 6.
Yeah, I think it ended like at $21.40 an ounce or so. I mean, I watched that pretty closely too, because I personally own a fair amount of physical silver, and quite a few of our clients, own silver too. But I think it ended up, pretty high. Let's see, AP. Let's see. Silver finished at, wow, $22 an ounce.
Wow,
that's huge.
What was the move then? 8%?
I think it was maybe even more than that. I'm going to pull up my chart so I can take a peek here. Let's see.
Holy cats!
I mean, I think it was flirting with like $20 like on Thursday.
Yeah.
Silver futures. Here we go. Yeah, one day movement today was it was 7%.
7%.
The low this morning was $20.64 an ounce, and it finished at $21.92, and it's up a little bit more right now in the aftermarket. There was a lot of volume today too. I mean, there's a lot of people in there buying silver.
Bart says gold was up 50.
Yeah, gold. We own gold also. I mean, I even own platinum. So Neil, we talked before. I mean, you're a bigger believer in real estate. And honestly, a lot of my most successful clients, they own real estate. We are the place where you put the money that you don't know what else to do with, or if you're looking for additional diversification outside of your business or outside of your real estate holdings. We are the place where you go if you want to be able to be invested and have money invested in a place where it's liquid and you can get your hands on it. If you're invested in real estate, I mean, I've come across investors before where they have like 100% of their money invested in real estate. And when things go wrong and they need to get their hands on cash, it's impossible, because usually when things go wrong, Murphy's Law kicks in, and there's like a banking crisis going on, and nobody wants to lend money.
Yeah, no, I don't know. He froze up there for just a second, so I didn't catch the last part of that. But the bottom line was, if you're holding all real estate, you don't have liquidity.
Correct.
You only have leverage, but that leverage is only good in a liquid market.
Correct.
Otherwise, the leverage isn't available.
Yep.
And if you're in trouble, you can't get the leverage that you need.
That's exactly right. And Neil, let me know. I'm sitting like down in my basement, and I've got a repeater that's near me. But if it cuts out anymore, let me know, and I'll move around.
Okay. Then in regards to let me ask you this question. So people are trying to, first digest what's going on in the market, right? And they're seeing banks going under, and then that's kind of freaking them out. I will say this much, people, you guys mostly aren't going to go like, wow, you're going to sit around and read prospectuses every day. I mean, that's just not what you do. So understanding, that's why I bank at a community bank for multiple reasons. One is I know the bank, I know the people running it, they know me, they know my name, all this kind of stuff. I know what they're up to. So I'm comfortable with them. I do not bank at any big bank. I won't. I have no interest in it. I don't. I just don't. Now, again, this isn't telling you what to do with your money. This isn't like, hey, this is what you need to do with your money. I'm just telling you what I do. I will not bank at a big bank. It's just not going to happen. I like Chase and Wells and those guys. They're out for me. I mean, I have no interest in them. Partly for political reasons as well as the other, because they all seem to go down Wokester Road. So, which
well,
is
the other thing I can tell you too, Neil, is that a lot of people that are out there that got money invested, more times than not, we find that it is with large companies that are out there. I worked for 10 years for Merrill Lynch, and they got bought by, they got taken over by Bank of America during the last crisis because they had to. The company was like 48 hours away from going, from being bankrupt before they got bought out. But if you've got money with those large firms, in my opinion, I think you're kind of like feeding the beast that is against election integrity, that is against our core values. And I'm a big believer in using community banks. I use one myself.
I got a question for you, David. So, because I'm gonna roll into just some thoughts on things. But do you own it? You have like you a little bit of a prepper? Do you have like a few months of food sitting around and that kind of thing?
Of course.
Yeah. Okay.
You'd be a fool if you didn't.
Segue. I'm going to link to my Patriot Supply, mypatriotsupply.com. Anyways, there's a link in the description, people. If you you do not have to get freeze-dried food from My Patriot Supply if that's not something you can do or whatever. But make sure you have some food around it. And I'm not like one of these people who's got years and years of stuff. I mean, I just not. But I got a few months. I mean, I think I can figure things out in a few months. I'm pretty resourceful. I want to have a few months of food around for me and my family. I probably have 6 months. I don't know, something like that. But I just some dry food, and we live off the grid. So, but My Patriot Supply actually has good food. I got some ReadyWise stuff. It was terrible. Oh gosh, it was gross. I'd gotten it because I was out on an elk hunting trip, and I just picked some up at the store. We were running low, and I picked up this, and it was like this potato soup. It was it was the grossest stuff. We didn't even want to eat it. Anyways, elk hunting is by the way, people, I will say this much. I have been doing as much content because I have been prepping for elk hunting season. It is time to get permits. It's time to pick areas. This is very, very important to me. Antelope, elk, mule deer. I want to do more hunting this fall than less. So you're
gonna have to send me some elk jerky when you get a chance. One of my best friends, went elk hunting a couple of years ago, and he made a ton of elk jerky.
Yeah, well, I have Fred's Meats in Goodland, Minnesota, which is the greatest meat market in the world, and it's right over here. I'm telling you, I just buy their beef jerky and eat it. But we did get a dehydrator. So Lisa asked me if I've tried bear. Bear's disgusting. I can't eat it. If I shoot a bear, I'm just taking a rug. I do not like bear meat. Anyways,
wild hogs are really good.
Yeah, I got to get down there with you. We got to shoot some wild hogs. We got to take some out.
Acorn-fed hogs are fantastic.
Pestilence, So so how would you, you don't know everybody's individual situation, but people talk about diversification. What's your general investment strategy, especially during times like this?
Well, right now, we have a fair amount of cash and bonds, like short term. We've got short term treasury bonds. Anywhere from I think we've actually got bonds that are coming due like either every month or every 2 months, going out for a year. We were buying them, even last week we were making like 5% or so, and that to me is just as good as cash. but with a slightly higher yield. So we've got that. We have very little invested in stocks right now, and we're being really careful. One of the things that people need to understand is that the overriding theme that's like in my head right now is that we went for 40 years from 1981 through through the beginning of 2022. So 1981 through 2021, interest rates and inflation just decline for 40 years. And now interest rates and inflation are going up. And I think that there's this desire to have the pain end, quickly. And as much as I would like for it to, I don't think it's realistic to think that way. I don't think you fix 40 years of declining interest rates and declining inflation and a Federal Reserve that is pumping money, into the system along with the Treasury. I don't think you fix it in 18 months. So I don't know how long this is going to last, but I do know that when we were talking before about, this inverse relationship between bond prices and interest rates, technology companies and startup companies and companies that don't make very much money right now are just like really long-term bonds that come due 30 or 40 years from now with the promise to pay big money, in the future. And so when interest rates go up, those things come down quite a bit. And so a lot of those technology companies that were dependent upon low interest rates and aren't really profitable, those things got hammered last year, just absolutely hammered. One of them was a company called Carvana. Their stock was up like around $350 a share or so. I had a client that said, "Hey, what do you think about it?" And I said, "I don't think they make money. I don't know when they're going to make money. I think it's a cool concept and a neat idea, but fortunately, we did not buy the stock, for him, and it went from 300 all the way down to as low as like $4 or $5. And I think maybe like right now, I haven't looked at it recently. I think it was around $10 like in the last week or so, but." You're talking, that's permanent destruction of capital. When you buy something at $300 and it goes down to $10, you can't make it back. I mean, you literally have to like win the lottery to make money back on something like that. So that's what's happening. But going back to what I just said a minute ago, I don't think you fix declining rates and declining inflation and tons of money being pumped into the system in 15 months. So we're just being careful right now. And I think that in this kind of environment, the companies to me that make the most sense are companies that produce a lot of cash flow, that have sound balance sheets. They don't have a lot of borrowing, or meaning they don't have a lot of debt. And it's just a really complex world. And it seems like the world right now is moving at 3 times the speed it used to move at, 20 years ago.
I think what happens is, like, with whether it's Carvana, whether it's Snapchat, or whatever tech company, I think people chase big returns. They want that flash in the pan. People say, "Oh my gosh, so and so made 15%," but then when Netflix, was a rocket ship, and then it tanked to, holy cats, what did they lose in like 700% or something? It was insane.
I think it went from like $700 a share down to like 150. I think it's recouped maybe like half of that so far. But
so that's the problem with these flyers is, so here's the problem. If you bought in at $700 and some dollars a share, and then it's down at 150, now other people are buying in at 150 and they might be winning, but you've got to get back to 700 just to get back to break even.
Right.
And so what does that do for you? So I actually was sitting there thinking about this, and I was looking through, and I saw like LKQ, which sells, auto salvage. And I thought, oh, that's kind of interesting, because what are people going to do? So I think, part of it is kind of, finding the disruptors, right? So you look at and you say, well, new cars are way too much. People can't afford them. And even used cars. So what do they have to do? They have to put money into the vehicle they have. And then you couldn't even get parts because of supply chain problems. So where are they going to go? They're going to go to junkyards. So LKQ actually was a good bet. for a stock. But I tend to look at these price to earnings ratios, and when I'm seeing historically, what's the long-term average price to earnings ratio? Somewhere around 12 to 15, isn't it?
No, it's if you average in like the last 15 years, I mean it's really closer, I think, to like around 16 or 17.
Okay.
It got
But if you took out the last 15 years.
Yeah, so I mean, so prior to the Federal Reserve getting involved in everything, it was lower. It was between 13 to 15 times earnings is what you're looking at. But even that is a little bit of a misnomer, because anybody who's watching right now, if you're a small business owner, you know that you can manipulate what the earnings are of your company. So if your income is this, and and your expenses are less, then the difference is going to be the profit you're taxed on. But if at the end of the year you say, you know what, I need to go get a new truck, I need to buy some new equipment for the office, I need to buy some more equipment for the job site, you can raise your expenses up to to meet what what your revenue is, and then magically you have no earnings. And that's one of the things that Amazon did for for a long time. They were spending a huge amount of money building out warehouse and distribution facilities. And so for the longest time, Amazon was selling for like 1,000 times earnings. And then people would say, oh, they're so unprofitable. But in our business, you have to take another look. You have to look at something called the cash flow statement. The cash flow statement really tells what the true story is. It tells you, like, where is the money going? And if you see that there's a lot of money that's going into things like capital expenditures and paying for buildings and paying for equipment and things like that, you can tell that you have a pretty healthy business that's going on. But if you see a company that's spending a huge amount of money on on interest carry and debt and things like that, just waste, or commissions and selling, SG&A is what they call it, selling in general administrative expenses. When you see a lot of that kind of thing happening, I tend to shy away, because it tells me the company's being wasteful with the shareholders' money.
Yeah, I think that's a great point. My friend the banker, he always he was telling me a story one night, and there was a guy who used to do a lot of land development. It was Brian, and they were at an event, and Bruce was relating a story. I had this guy come in, he's looking for a loan, and he tells him kind of a little bit about it. And Brian goes, "What kind of vehicle he drive?" And Bruce said, "He drove an old Ford Ranger." "Give him the loan," Brian says. "Give him the loan." Because what it said was he's putting his money into capital expenditures, not on a vehicle for himself. And that's
Right.
Ultimately what you're looking for with these companies, is that they're actually putting the money back into the business, as opposed to I gotta, like, there. I gotta get that light stream. Anyways, but yeah, so. But I do tend to, think, like, when companies don't seem to get off high price to earnings ratios in historically. So even if it's at 17% or 17, I'm sorry, 16, 17 on price to earnings ratios, what are we at right now? It's probably fallen back. It was 30 something.
It depends on what the number is. So, I mean, so I think the expectation right now is that the S&P is going to make around $220 a share in earnings this year. And today, I think the S&P finished at around 38.55. So if I take 38.55 divided by 220, it's selling for about 17 and a half times earnings right now. So
Wow.
it's probably, for all I know, it might be selling for about what it's, what it ought to be selling for. But again, this is not financial advice. This is just, you just got to be incredibly careful right now. You have to, one of the biggest hurdles that we find when it comes to being a successful investor is that to be successful, you have to stay in the game. And you can't be constantly trading, in and out of things. I mean, sometimes you buy something and it pops up really quick and it hits your price target, and you should, take profits. But, other times there are times where it's best to, leave your money invested and let it grow and let it mature. So I think everybody's very different right now, and you just have to be really careful with what's available out there. And you really got to dig quite a bit to see what's really going on behind the scenes.
Well, that which brings me to a segue. So, David, you're a fee-based financial planner. So you typically are dealing with some higher net worth individuals that maybe they're moving a couple $100,000 or whatever, and they're saying, "Look, I need my money taken care of. Do this with it." And so that's really what you do. I mean, these people aren't just like checking in all the time; they're trusting that you're actually gonna, make sound decisions, right? Is that kind
Yeah.
of your?
Yeah, that's the vast majority of the people that we work with. That's exactly what it is. So I mean, frequently, like our typical client is somebody who's they're usually over 50 years old. They have accumulated some assets, and a lot of times it's scattered in a bunch of different places. So they might have like an old 401k someplace. They might have a savings account someplace. They might have a credit union account someplace. They might have some mutual funds. A lot of times we find people that've got stuff scattered everywhere. And it's not because they're lazy or they don't care. It's because they're busy. They're busy with their life, their business, and their kids and that kind of thing. And they wake up one day and they figure out that they're an unimportant client to a bunch of different people, and so nobody pays attention to them. And so what we are really charged with is helping those clients put together a plan that looks at each one of those pools of money as if it's a soldier, put them in line and get them marching, in line towards what the client wants to try and achieve. And let me just clarify too. So when you say that we're a fee only based, financial planner, what that means in this context is that we manage money for our clients for a fee, so a percentage of the value of a client's account. We don't charge commissions. We don't buy mutual funds that have sales charges to them or anything like that. It's just I'm a very big believer in simplicity. So we bill our clients once a quarter. We're never tied up in something where somebody says, you know what, this is just not working out for me, and I want to leave and go someplace else. You're not locked into something where you can't get out of the investments with us. So everything that we go into is liquid. So I'm a big believer in in truth, in simplicity, in logic, in understanding. And again, in order for our clients to be successful over time, they not only have to have trust in what I'm doing, but they have to have a certain level of comfort to be able to ride out the inevitable storms that happen. So like even today, there was a lot of craziness that's been going on, and even on Friday there was a lot of craziness going on last week. We got very few clients that call us and go, "What's going on? I can't stand it." It just doesn't happen.
I'm gonna link here. You guys can there it is again in the chat, us-am.com, and go check out David's website. If that's something that you need is somebody to manage funds, by all means. Like I said, I'm doing some things with David now, and David, I've always appreciated you in your work with Garland and what you've done quite pro bono for the movement. So the nice thing about so I'm a big believer in just not giving my money to people who hate me, I guess, is really what it boils down to. And I mean that. That's why I don't shop at Amazon. It did pain me last week. I finally had to order something from Amazon. I hadn't in 4 years, but I could not find the stupid thing anywhere else on the web. I could find it listed at a couple other places, but they were all out of stock, and I needed it for my car. And I'm like, oh gosh. And then, do you know what? Because I thought they were supposed to be the fastest game in shipping. They didn't even ship it till the other day. I mean, maybe it's sitting on my money for close to a week before they even shipped it. God, they suck. I can't stand them. And then they Washington Post. Oh gosh, it was $25, but it was really I wasted an hour just trying to find another way to get it because I just cannot stand giving money to these people. So that's why I like working with people. That's why I bank where I bank. That's why I'm working with David. That's why I buy my stuff from people. That's why I like Mike. That's why I get my coffee and my pillow. And people like, some people think he's crazy. I like the guy. I mean, I've sat and talked with him, and he's pretty fired up. And does he get everything right? No, but he doesn't hate me. He actually likes me, and so I can, seriously, I'm so tired of this this whole wokester road and what it's doing to our country. I don't want to support him. I just don't. I can't. I just I don't want your ESG scoring crap. I don't want any of that. So that's so there. Just I plug again. Go check out his website if you want to. And I think any closing thoughts before I wrap up the show, David?
I would just tell you. So I'm gonna put a link down here in the private chat for you to be able to share with folks. It's a link to like a special form that we've got. So if anybody would like to to connect with us, this is an easy way to do it. It's an easy way to tell us like what's important to you and what you're trying to accomplish.
Okay, that's the Patriot Inquiry.
Yep. Yep.
So there you go. I'm posting it in the comments, folks. So it's us-am.com, Patriot for dash slash inquiries / so you can go check that out. Yeah,
and
I think
I would just only other thing I would add is that we get people that reach out to us sometimes that say, I have no idea, I don't know anything, this is a dumb question. I'm a really big believer that the only dumb question that's out there is the one that's not asked. So if it takes a little while to help you understand like what's going on and to educate folks on things, we're big believers in doing that. And we're getting we're beginning to publish a little bit more and put out more in the way of like video, because I used to write like a monthly newsletter to send out to clients and to potential clients. And one day one of my clients contacted me and she said, I really think that what you've got, you put a lot of work into, and it's really thoughtful, but it's 5 pages long, and I feel like you're assigning me homework. And I really don't want that. So they want something that's simple. And so I think you'll probably be seeing more like short videos from us about like what's going on and what's happening.
Okay, cool. Well, thanks for coming on. And again, people, don't panic. Don't make good decisions with your money. Just don't carry large debt loads. Don't carry debt loads on credit cards. Own your vehicles. You should never have a loan on a vehicle unless you're doing like a vehicle lease and it's your business or something along those lines. Otherwise, they never make sense.
Yep.
None of this stuff that they're trying to, you don't deserve it. The whole marketing ploy, you deserve it and all that. No, you don't deserve it. If you need it, you need it. Or if it's a want and you have the money, buy it. But it don't go with that whole, they try to market to you all the time. You deserve it, buy it now, all this crap.
It's all about keeping you a slave to the system, paying that interest.
Oh, it is. And keeping you just, and then not only that, people are kept in jobs they hate because it's slave to the system. They want perfect consumers. That new lady over in Italy made the perfect speech about that. I don't know if you ever saw that. It was absolutely one of the best speeches I ever saw a politician deliver. And it was phenomenal. I can't even remember her name right now. What is her name? She's just a beautiful lady. I just love her spirit. Yeah. And so people, please, honestly, we need people who are making sound financial decisions, who are not, who are dug out of debt. We need people who have freedom of mind to do the things that they need to do. You cannot do the things you need to do if you are slave to the grind, slave to debt. You can't do it. And don't let it happen to you. All right. I love y'all. Keep fighting the good fight. Peace out. All right. Subscribe if you're new.
Thank you, Neil.
Thank you, David.